Level 1. Imagine waking up to headlines about layoffs, businesses closing, families struggling with higher prices, and yet somehow, the stock market is hitting new highs. At first glance, it feels absurd, almost like watching a luxury yacht party while the harbor is on fire. So, what exactly is going on? And why does the stock market sometimes seem to live in a completely different reality than everyone else? The answer begins with a simple misunderstanding. Most people think the stock market measures how the economy is doing right now. It doesn't. The stock market is a giant prediction machine. It is constantly trying to guess what the future will look like 6 months, 12 months, even years ahead. That's important because the economy and the stock market move on different clocks. The economy reports what already happened. The market bets on what happens next. Think back to 2020. Millions lost jobs. Entire industries froze. The global economy entered chaos, yet only months later stock markets were climbing rapidly. Not because investors believed everything was fine, because they believed things would eventually become fine. The market wasn't celebrating the present, it was pricing in the future. But that's only part of the story. Here's where things get uncomfortable. The stock market is not the economy. It's a collection of companies, and increasingly it's a collection of very specific companies. A handful of giant corporations can have an enormous influence on the entire market. If a few trillion-dollar companies perform well, stock indexes can rise even while many smaller businesses struggle. In other words, your local restaurant can be suffering while major technology firms are adding hundreds of billions in value. Both things can be true at the same time. Then there's money itself. When central banks lower interest rates or inject liquidity into the financial system, investors suddenly have more cash looking for a home. Savings accounts become less attractive. Bonds become less attractive. And that money often flows into stocks. Not necessarily because companies are thriving, but because investors are searching for somewhere, anywhere, to earn returns. It's a strange irony. Sometimes stock prices rise because conditions are good. Sometimes they rise because policymakers are trying to fix conditions that are bad. And that's where the biggest misunderstanding happens. When people hear the market is up, they assume everyone is winning. But stock ownership is heavily concentrated. A large portion of market gains often flows to a relatively small percentage of households, which means stock market records can coexist with financial stress for millions of people. The headlines say prosperity. The reality feels very different. And that disconnect creates a question that investors, economists, and policymakers continue to wrestle with. If markets are supposed to reflect economic health, what happens when they become better at predicting wealth than measuring it? Because the next time the stock market surges while everyday life feels harder, the real question may not be why the market is rising. The real question is who it's rising for.